Alrighty. So today's video, I'm going to be talking about credit spreads, and in my opinion, I think that this is the fastest way to grow a small account, especially if you have an account size that is under $25,000. That means you could have an account size of $15,000 or $10,000 or even $5,000. And I'm going to explain to you why. But first off, what are credit spreads, right? So credit spreads, they are also called the short vertical spreads, and these are premium selling defined risk option strategies that lets you take a semi-directional bet in the market, which also means that you do not necessarily have to be right on the direction. If you're slightly wrong, you still are able to profit from this credit spreads, and I'm going to explain to you why later on. But credit spreads, well, basically they come in two flavors. You have the bullish flavor, which is what you call the short put spread, also known as the bull put spread. So basically what you do is you sell an out of the money put option. All right, you sell an out of money put option, and then you buy back in further out of the money put option. So in this case, you're pretty much hedging your risk, because if you just sold the short put down here, this would be considered just a naked put, and the risk would basically be unlimited until zero. So if the stock really goes to zero, then you're going to lose a lot of money down here. So that is why we have this long put. So assuming, right, this is the stock, and let's say that you have a bullish outlook, you think that the market is going to bounce back. So what you do is basically you sell a put option that is out of the money, right? So you sell a put option here that's further out of the money, and then you buy back another put option that is further out of the money. So in this case, you kind of hedge the risk to the maximum of the width of this spread. So from here to here. Now, some people also do at the money put spread. So that means you could have sold the short put here, all right? You sold the put option here, and then maybe you buy a put option here. This is at the money. Some people would even go to do an in the money short put spread. That means that they're going to have the short put that is in the money, right? That is above the current market price, and then you have the long put somewhere either at the market or further out the market. Now, for me personally, I do not do that. I prefer to go for the approach where I go for the out of the money, right? That is because you have the probability in your favor. Basically, what it means is that if the market still, all right, let me just remove this so you can see it more clearly. So let's say, for example, if the market, you're slightly wrong in the direction, it comes down here, and then it just dwindles sideways, does nothing at expiration. So in this case, in a sense, you're wrong in the direction, right? Because it came down lower from whence you put on this short put spread, but you're still able to profit because it did not breach your short put strike of your short put spread, right? But if you had done, let's say, an at the money, right? So imagine this is the short put, right? The short put, and then you, let's say you bought a long put just below that. Right now, in this case, it would be a loss because the price has now gone below your short put strike, right? So you don't really have a probability in your favor, although you have a larger credit upfront. Now, in this case, for me, I prefer credit spreads where I do have an advantage in terms of probability, so that in the long run, right, at least I'll tend to win more often than I lose, right? So some people do at the money, some people do in the money. I prefer out of the money. Now, the next flavor is the bearish flavor, right? So this is what you call the short call spread, also known as the bear call spread. So this is the opposite of the bull put spread. So the bull put spread, we are using basically put options. For this bearish credit spread, we're going to use call options. So it's basically just the opposite, right? So you're going to sell the out of the money call option, and then you're going to long a further out of the money call option. So for example, this is the market. Right, let's say it's going up and you think that the market is going to go back down. You have a bearish outlook on this. So what you do is you're going to sell in out of the money call option, and then you hedge it, or rather you define the risk on this naked call, right, with a long call option. So this way you have a spread. So this way, again, the max loss will be the distance of this width minus off the credit which you receive. I'm going to explain more about this later on, but basically what you need to know here is that your max risk is capped, right? So you have always heard that, you know, it's dangerous to go naked, right? To go naked put, naked call, and that is true to a certain extent if you don't know what you're doing. But in a sense, if you have a small account where your account size is small, then it's definitely much better if you are to do a credit spread, because this case, right, you do not just let one trade go against you. Because what if the market, right, let's say it really shoots to the moon, right? It goes all the way to, you know, from $1 maybe shoots up to $100 or something like that. In this case, even though it goes to $100, your max loss has been capped. But if you have a naked call, then guess what? You have to absorb all the losses as it goes up, and really your loss will be unlimited, right? So this is why the credit spread is good for this small account. So let's get into this a little bit more. So why use credit spreads for small accounts? Well, first of all, it is a high probability trade setup, right? Generally, the way I do it is where the probability of profit is more than 70%, right? I'm going to share with you the mechanics, but basically in a nutshell, I like to go for the short put strike somewhere around 30 deltas, right? 30 deltas or less. So this way, I'm always selling slightly away from the market. So as you can see, this is a short put spread, also known as the bull put spread. So this is where the current market price is. So you can see that most of the time when we are doing the credit spread, or rather the short put spread, in this case, we're going to sell the short put spread away from the current market, right? So in this case, we're going to go below the market. If you're doing a bear call spread, you'll be above the current market price. So this way, you can see down here, the percentage is 71.37%. So you're going to be right more often than you're wrong, right? So you're going to be winning more often than you're not. So the good thing about this credit spread as well is that time decay is on your side. So because this is a premium selling strategy, so as you can see, this curve right here is the P&L that you have for when you put on the trade, right? So as in the moment you put on the trade, let's say today you put on the trade, this is your P&L graph. But you notice the green line is at expiration. So it means that, let's say for example, if the market actually goes down to $180, right, at this point, today itself you'll be losing money, right? You can see at this point, this is the $0 line, right? Anything below the $0, this line down here, you're in a loss. Anything above here is a profit. So let's say it goes down to $180 today for some reason, right? Then you would be at a loss. But guess what? Because of time decay on your side, and because you have a short put strike that is out of the money, which is way below this current price, at expiration, what happens is that this purple line will slowly go up because of time decay to this final point down here. So that means that if you actually held this short put spread all the way to expiration, and assuming that the price actually just settles at $180 at expiration, you'd still be at a profit, even though, right, you entered this trade when the current market price is much higher. So that is why this is time decay, right? Time decay is going to work for you if you are inside of the break-even point. So this is the break-even point down here. Right, anything past this is you're going to lose money. Above this, at expiration, you're going to make money. So let me just remove all these drawings to make it much clearer. So basically, what you want is to ensure that the price, right, does not go past this break-even point. So break-even point, anything before this point, all the way above here, the time decay is going to work for you, because as you can see, you're going to lose lesser, right? You're going to lose lesser as this P&L graph is going to fit up. Anything below here, or rather the break-even point, past this point, in fact, you're going to start to lose even more money as time goes on. So this is where the time decay actually works against you, because remember, you have a spread on. That means you have a short strike and a long strike, and that is why this friction between these two strikes is causing this part, right, towards expiration, is going to finally come down to this graph down here. So I'm going to show you how to manage it later on, because at most of the time I do not tend to hold this spread to expiration, especially if it's outside of this break-even point. This way you will limit your loss. Alright, so next, quick profits if you're right on the direction. So as you can see, this is a bullish setup. This is a bullish option strategy. So if at the point of time when you put it on, if the market goes up, let's say from 180 it goes all the way to, around 182.5, goes all the way to around 190 something, you're going to make money, right? So it takes a few days, you're going to make money. It's definitely much faster than neutral strategies such as iron condors, right? Iron condors is basically both sides of the credit spread. So you have the short put spread plus the short call spread, so you get iron condor. Now if you're not very familiar with what the iron condor is, I've actually created a video dedicated to the iron condor. You can go ahead and watch that. I'll put the link at the top right hand of the corner. But basically what you need to know is that because this is a semi-directional, right? Some people say it's a directional trade. Either way you want to put it, as long as the trade goes in the direction of where you put it, you're going to see the profits very quickly, right? Iron condor, it's going to be a friction because you want to make sure it stays in within a certain range, right? Let's say, for example, you have the call spread down here, all the way to the bottom. So basically, you want to stay in within this range, between this range and expiration, so it takes much longer. Next is that you can be wrong in direction but still profit, as I mentioned earlier, right? If the market comes down to this point, expiration, you still can profit, right? As you can see, the P&L graph will be at max profit at this point, even though it's below the current price when you first put it on. The max risk is defined. We talked about this as well. So this is important because with a small account, you don't have a lot of cash, you don't have a lot of bullets, so to speak. So if you're going to let just one single trade, a lot of people like to put on naked puts and naked calls, especially if you do them on those kinds of stocks or ETF that has a very high price. Then you're going to see that if one time the market actually moves against you very quickly, you're going to lose a lot of money, especially what we've seen during the pandemic and the recent 2022 crash, right? So that is why with this vertical spread, with this short put spread in this graph, you can see your loss is limited. So the market can go to zero for all at once. You're still going to lose the maximum down here. Now you can also use this on any stock or ETF regardless of price compared to naked option strategies, right? Naked option strategies, you have to take note of the buying power, and sometimes the buying power will vary, very dependent on firstly the price of the stock. Of course, a more expensive stock, you're going to have higher buying power reduction, so that's going to take up much more of your account. And secondly, when the market actually crashes, when there's high volatility, your broker will increase the buying power requirement, and that's going to increase the amount of capital that's going to be hold up in that trade, right? So you're going to be you're not very sure how you're going to manage your position sizing. But with this credit spread, you know for sure every time what is your maximum risk. Okay, so because your trade is fixed, your risk per trade is fixed, you're able to position size this very properly. All right, so let's get into the mechanics so you know a little bit of how to put on this bull put spread. I'm going to share with you my mechanics. Now you can change them in a way which is suitable for you. This is what I like to do. Now there's no one set way. You find one that is good for you, but this is mine. So basically what I like to do is I like to wait for the stochastic oscillator to be oversold. Right, I talk about the stochastic oscillator in another video as well. You can go ahead and click the link at the top right hand corner of this video. You want to find out more about stochastic oscillator. But basically what it does is that it just measures whether the market is overbought or oversold conditions, right? So if we're going to go for a bullish setup, then we want to try and put all the odds in our favor. So one of the ways is to ensure that the stochastic oscillator is to be oversold, right? So if you want to put on a bullish trade, would you rather put it when it's overbought or if it's oversold, right? You definitely want to put it as oversold. Now, of course, you can always go more oversold and so on, as I always mention in all those videos, but at least you have a higher chance of it working out, right? You're not going to win all the time, but you're going to win a lot of the times. And each time we win, we want to make sure that the conditions are right. Next, we want to sell on a down day, right? We want to sell on a down day for increased volatility, because when the market is selling off, volatility increases, and because this is a credit spread, this is a premium selling spread, we tend to get more premium when the market is has an increased volatility. So that's why we sell on a down day. Now for me, I like to sell the 30 to 60 days to expiration. Some people like to go for the weekly. Again, this is something that you want to try out for yourself. I prefer the longer dated expiration, only because I can get a strike that is further out of the money. So for example, if the stock is, let's say it's doing this, and let's say I want to get a strike somewhere at this point down here. All right, pardon this not so straight line. Let me just try that again. There you go. All right, so let's say I want to go for this strike. I've decided I want to go for this strike. So now I have two options. If you have the weekly options, chances are that I might not be able to get this strike, because weekly options, right? If you're going to go for something 30 deltas, it might be nearer to the market, and I might not be that comfortable with that. But if I go something for 30 to 60 days to expiration, I can see that I can get a further away strike, which is what I want, which is also technically I might be looking, right? Maybe this is the previous low, right? So this is the previous low. I want to make sure that my short strike point is below this previous low. So if you're going to go for a weekly option, maybe 2 weeks out, 3 weeks out, right, you may have to wait for the market to come down a little bit further before you enter the trade, or you might just have to, just go for a nearer strike. Okay, again, this is all up to you to go and try out for yourself. Next, for the shock strike, I like to go for around 20 to 30 deltas. That is how I ensure roughly my trade is around 70%, sometimes 60 something percent, right? And preferably below a support level or previous low, which I talked about. All right, you're going to look at the previous low, and I'm going to show you with a few trade examples as well. And your long strike, I generally like to do it at $5 away, right? At $5, some people do $10, some people do $2. I like to do $5 because this way I can have a proper way of counting what is my risk. So in this sense, let's say for example, if your spread is $5 wide, that means the maximum loss is going to be $5 minus the credit you take. So let's say if you take a credit of $1.50, which is what I suggest to get, anywhere from $1 to $1.50 in credit, which is $150 per contract. Right, so your maximum risk will be $5 minus $1.50, which is $3.50. Right, that's your maximum risk per trade. So I tend to always aim for this amount. Next, you want to risk a maximum of 1 to 5% per trade. Now, the next is trade management. So this is pretty important. So I want you to take some time to really listen to this part, because there are 4 different methods that you can use to manage it, right? So the first method is to just take profit at 50%. So what you want to do is you just place a take profit at 50%, so it will either expire where you lose the full amount, or you get to take 50% profit, right? So this is basically the first method. Now the second method is that you can just simply hold it to expiration, or in a sense close to expiration, right? So you want to close it either a day before expiration, 2 days, or on an expiration day itself, right? So this way you're either going to get close to the max profit, or you're going to get close to the max loss. So if I bring up this graph again, you can see that chances are, if you're going to hold to expiration, it's either going to fall from this point on, from this green line down here, the max profit, or from here. So it's either one of them. Now the next method, right, is to manage your loss more aggressively, and that is to wait until 21 days to expiration and close the trade regardless whether it's a win or loss. Right, now there is a lot of studies done by the Tasty Trade folks, right? You can go to the website, search for 21 DTE, and you notice that they did a lot of research on closing out option trades around 21 days to expiration, and they found that you can actually have an improved performance, right? That means overall you're going to have a higher return if you manage it at 21 days to expiration. So this way, even though it is in a loss, you're going to close it. In a win, you're going to close it. Small win, small loss, 21 days to expiration, you close it. But what I prefer is actually method 4. That means, first of all, I'll wait till 21 days to expiration, and then I'll take a look where it is on the P&L graph, right? So if it's outside of the break-even, I'm going to close it for a loss. But if it's inside the break-even, I'm going to just hold it until I hit the 50% profit, or until it goes outside of the break-even. Then I'm just going to close it for a loss, right? So I'm just going to give you an example of what I mean down here. Let me just remove all this drawing. So you notice that our short put strike is here, and our break even is at this point, right? So generally anything past this break even point, I will consider it as a loss. Anything above this break even point, there's still a chance for a profit. Now if you use the 21 DTE kind of a strategy where you just close it when it's 21 days to expiration, chances are that if the market actually lands somewhere at $180, right? Let's say it goes to $180, you notice that it shows a loss, right? It's a loss. Right, it's below the zero line. But the thing is that it's still above our short put strike. So that means there's still a chance for it to work out, right? It could still go out, right? So that is why I like to wait for it to see where it's at the 21 DTE mark. So let's say at 21 DTE mark, it's at this point down here. What I'm going to do is I'm just going to hold it, right? I'm just going to hold it because as time passes, remember this graph down here, this P&L purple line down here, it will start to move up. You'll start to gravitate all the way to this point, so it can actually become a winner. Or even better yet, if the market starts to go up after that, then I'm going to profit even quicker. All right, but the main thing is I'm trying to give it a chance for the price to come back up, right? So this is the method which I choose, and the only time I'll close it is, let's say it's 21 days to expiration, it's down here, but then a week later goes by, and then it starts to breach this break-even point. The moment it breaks this break-even point, let's say it goes to around 175 or something like that, At this point, I know that as I hold the trade, right, this P&L graph down here, this purple line, is going to start to drop down. It's going to start to go down, and it's going to make me lose even more. So this is where I will close the trade. So that is how I manage my bull put spread, and you want to choose one where you feel comfortable with. All right, so I'm going to share with you some trade examples. So the first trade example, this is IWM, which is the iShares Russell 2000 ETF. So on this day, as you can see, it is oversold. Right, it is oversold. You can see down here the stochastics. So the market is going down. So what I did is I placed the short put spread at 175 and 170. So as you can see, I was very fortunate enough that the market rallied right after that, and I managed to take my profit roughly 1 week plus, right, in 11 days. So as you can see, it's pretty quick. And here's the thing, if you actually held it to expiration, you decided to, you go for the method 2, hold to expiration, then there's a chance that you might hit into a loss, right? Because the market came down later on because you did not take the profit. But then again, if the market went all the way back up, you could have gotten the full profit, whereas I've only gotten 50%. So again, we never know. So it comes down to the mechanics that you want to choose, how you want to manage it, and then you want to stick to it, and then just monitor the trades that you put on from there. All right, trade number 2, again, this is IWM. So IWM, again, on this day, you can see that this is right after this trade which I put on, the market became oversold again. All right, as you can see, it's oversold. So at this point, I'm looking to put a short put spread. So the short put spread I put is roughly around 27, 25 deltas around there. So 160, 155. And then this is basically what I mean, where you are not exactly right on direction, but you still make money, right? So because when I put on the trade, the market was around 170. Right, it was around 170, and you notice the market actually dropped, right? It dropped to roughly around 16, maybe 163, 162, and at this point it was showing a loss. But then because of the nature of this short put spread, of the time as the market goes up and time decay, I managed to hit the 50% take profit in 13 days. Now next, I have another short put spread example. This is on SPY. All right, SPY, again down here, this is oversold. Again, oversold down here. So what I'm looking to do is put on a short put spread. So the short put spread I want to put is 360 and 355, and I like to put this below the previous low. As you can see, this is the previous low. So this way, there's a chance in case, like, if it hits this, there's some sort of a support, it might bounce back up. Or at least this is the thinking that I have when I put on this trade, right? As long as you have the odds against you, right, even though if you lose, that's fine, because you know that in the long term it's going to work out because you have things in your favor, right? You put it below a support level or at a support level, and then the stochastics is showing oversold, right? Definitely you want to do this, that you want to put on a bullish trade when it's oversold rather than when it's overbought, right? So again, try to put as many things in your favor to make it work out. Right, so as you can see in this trade, again, this is another example of the trade where you're wrong on the direction. As you can see, actually blew past my long put strike for the credit spread, but I still managed to take profit, right, much later. No, this is not 30 days later. This should be about 30 days later. 30 days, this is a typo. It took much later. As you can see from here, at this point, the market, this is where I put on at this candle down here. When I put on this short put spread, the market just went further down, right? But at this point down here, here's the beauty about this thing. It has not crossed the 21 days mark. When I put on this short put spread, I think it's around 50 something days, 40 something or 50 something days. And then at this point of time, there was still more than 21 days. So I wasn't looking to cut my trade yet, right? But if it's already past the 21 days, then I would be quite unlucky. I have no choice. I would be cutting this trade down here for a loss according to my trade management style, right? So in this case, it has not hit the 21 days. It was still more than 21 days. That is why I held on to the trade. And then when it reached the 21 days, it was still above my short put strike. So there's no reason for me to close out the trade. So I just held on until the 50% was hit, and it got hit a few days later from here. So overall, the trade roughly took about 30 plus days. So this way, as you can see, even though I am wrong on the trade, the direction, it's still pretty forgiving because I had this spread on, and I already have my trade management in place, so as the market bounce up, I could take profit. By the way guys, if this video has been helpful to you so far, I'd really appreciate if you hit the thumbs up button, and also share this to people that you think will benefit from this video, and also subscribe to my channel, so this way, I'll be motivated to create more videos like this for you in the future. Alright, back to the video. Alright, so for the next flavor, which is the bearish flavor of the credit spread, you have the short call spread mechanics, also known as the bear call spread. So now basically this is just the opposite. So whatever you have learned from the short put spread mechanics, this is the opposite, right? So instead of seeing oversold, you want to wait for it is overbought. Instead of a down day, you want to wait for it until it's an up day. So same thing, 30 to 60 days to expiration. This is same, 20 to 30 deltas. All this is the same. Alright, it's a short put spread, and your trade management is the same as well. So again, you want to choose the method that you feel most comfortable with. Alright, so let's get into a few examples, and again, this is on IWM. So on this day, you can see that the market, right, it was an up day, it was moving up at this point. I can see that the market is overbought, right? So it's overbought. This is where I decided to put my short call spread. So from here, I put on a 190 strike, 195, again 5 points wide per contract. Again, position it size to your account size. So you can see on this day, right, again, pretty fortunate. I got hit 50%, 13 days down here when the market went down on this bar. So I got about 50%. So again, as you can see, after that, the market actually rallied. So if you held this to expiration, at this point you'll be still pretty safe because it hasn't hit the short call strike. So what you want to do is manage it according to the trade management style, right? So if it's time to cut loss, you want to cut loss. Next trade example is on SMH. Now this is another ETF. This is on the semiconductor ETF. So on this day, you can see the market has rallied. Again, it is overbought. Alright, so again, for this, what I'm looking out for is to place a trade above the previous high. So in this case, will be the 250. Now, you will notice that the market actually is oversold at this point down here, right? This candle down here is overbought, sorry, it's already overbought, right? But I did not place a trade here. Why? Because I wanted to place the 250 strike, which is above this point. If I were to place it right at this candle, what's going to happen is that chances are this delta is going to be maybe like 10 deltas or 15 deltas. Now 10-15 deltas, what's going to happen is that although you're going to have a higher probability of profit, maybe it's like 85%, maybe even 90% profit of probability of profit, the problem is that you're going to receive very little credit, right? You're most likely going to receive under $1, right? So what it means is that if you're going to receive under $1, you're going to have to win many more times in order to cover just one loss, right? So I'd rather just wait for this to go up and then place a trade at 250. So that means that at this point in time, I've already placed my credit spread order at roughly around $1 to 150. So the moment it goes up, it will automatically fill this credit spread, my short call spread, and then I'll get filled. So in this case, I got filled when the market was at this point, which is pretty much closer to where this short strike is. So if you were to go for the weekly option, you will find that this is where your problem lies, right? So if you're going to go for the weekly option, chances are that your 30 deltas is going to get you somewhere around here, maybe 240, and it's going to be below this one. So it's going to be a little bit more aggressive. So if you want to go for the 250, if you're going for the weekly, you might want to wait for it to go a little bit higher. And if it doesn't go higher and it goes down from here, then you're just going to miss that trade, right? Miss the opportunity. Alright, so on with this trade. So as you can see, the market continued to go up. So in this case, it never hit my short strike. Another case whereby I am wrong on the direction, because from this point, I placed the short call spread. It went up, but it never hit my short strike at 250. Eventually, it went back down. As you can see, it hit my take profit 20 days later. Alright, so this is for the SMH. And finally, the third example is on CRM. Remember, I said that I generally do not like to trade on individual stocks, but during this time, I had a number of trades on other index ETFs as well. I want to put on the trade. So I saw CRM and I thought this was a pretty good trade, a pretty good setup, because I saw the previous high was here and it's overbought right at this point. Plus, there's the added benefit of this dynamic moving average down here, which serves as a dynamic resistance as well. So you'll notice that many times the market will go up, right, bounce off this moving average and then come back down. And this was what I'm sort of hoping that it would happen for this trade, right? So I placed the short call spread way above down here, so it's at 175, 180. Again, this is around 25 deltas, so the credit I receive is roughly around 120, 130, right? So as you can see from here, now I'm right on the direction. So this time I profit pretty quickly. As you can see, I got 50% take profit in just 9 days, because as you can see, it did turn out that it hit the dynamic resistance moving average and then it went back down. So this is the short call spread example. You'll notice that most of the examples I show here are winners. Now, of course, there are losers as well, but the losers are not as much as the winners. Overall, if you do it correctly, you're going to have a positive expectancy where you're going to win in the long term. All right, so here are some final takeaways. So the credit spreads come in two flavors. You have the bullish flavor. If you're bullish, you use the short put spread, and you have the bearish flavor where you use the short call spread, also known as the bear call spread. Now, credit spreads are excellent option strategies for small accounts because the risk is defined. This is key, right? Especially when you compare it to undefined risk strategies such as the naked put, naked call, and the strangle. So you're able to position size as well each trade properly because you already have the defined risk based on the spread width of your credit spread. So this way, you won't blow your account on any single trade. So many people, I know one of my friends as well, they have blown their account because they decided to do a naked option strategy on one of the index ETF, which was way too big for their account size. So when the market moved against them during the crash, they lost a significant portion of their account. Now, this is a high probability option strategy, so you win more often than you lose, and you can take profit very quickly if you're right on the direction, as you've already seen in my last example, and you still can profit even if you're wrong on the direction. So this is the beauty, right? It's pretty forgiving. So you can be slightly wrong on the direction, and because of the theta working for you, it does not breach your break-even point. You're still going to profit as time passes. So you have time decay working for you. And finally, it can be used on any stock ETF regardless of price. You can do this even on very expensive stock that's $400-500 because your buying power is kept at the spread width, right, of your credit spread, unlike the naked option strategies. All right, guys, so that's it for this video. I hope you like this video. I hope you have really learned something from here. And if you feel that this video has been helpful to you, I'd appreciate if you give me a thumbs up and also subscribe to my channel as well. And also, please do share this video to others which you think might be able to benefit from this video. And as always, thank you for watching. I appreciate your time, and may the options favor you.